You are listening to KeyStone Stock Talk Podcast, episode 58. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, we have a special episode which will feature part 2 from my interview in Toronto on Capital Ideas TV. Myself and host Mark Bunting talk KeyStone's general strategy, current market conditions, and review some past and current Canadian growth stock selections, including Sylogist Ltd, symbol SYZ on the TSX Venture, Parkland Fuel Corporation, symbol PKI on the TSX, Sangoma Technologies Corporation, symbol STC on the TSX Venture, and Viemed Healthcare Inc., symbol VMD on the TSX. Now, Q3 2018 earnings season has been a wild ride for Canadian and U.S. growth stocks, primarily to the downside. In the past month, a number of quality growth stocks have been punished for slight adjustments to forecasts, or even, in some extreme cases, for what amounted to unrealistic investor expectations moving forward. Essentially, the companies were punished for not continuing to grow at a quarter-over-quarter growth rate that should have been considered unsustainable. In some cases, the corrections, though, have been fully justifiable. In other cases, we would argue these have been great businesses that were just priced too high. Premium Brand Holdings Corp., PHB, on the TSX is a great example. This is a company that we definitely like the business, and we've owned it in the past. The growth here is great, and the company continues to have a growth outlook. But at $120, where the shares were earlier this year, or this fall in the $100 range, it was just too expensive. It was essentially priced to perfection. Premium Brands is a high-quality growth story, which has consistently grown by over 20% over the past 4 years. But the stock recently traded with a PE of beyond 35. At that rate, it is very difficult to sustain that type of long-term growth. In fact, in the face of any hiccup, the stock was vulnerable to a significant correction. That hiccup came in the form of a revision of growth lower going forward into Q4. The company is still producing solid growth. It is just not able to sustain the tremendous growth it had produced in recent years. For that, the stock is now down 42% from its highs earlier this year and has dropped 20% in a couple sessions following the Q3 report and conference call. Again, we like the business, but it is still not strikingly cheap near term, despite nearly being cut in half from its highs. This should give investors an idea of just how far near-term valuations had become stretched in some quality growth stock names. As investors, we must try to invest in great companies, but we must also assure that we are paying reasonable prices for those companies. In other cases, I'll give another example, such as Expel Inc., symbol DAP.U on the TSX Venture, a company we've had in coverage for just over a year now. The company reported tremendous growth numbers in Q3, boasting 64% revenue growth and a profit that was 4 times higher than the previous period, with a growth outlook going forward. Yet the stock initially sold off on these results and remains under where it traded when the numbers were announced. This tells us the markets are jittery and appear to be in risk-off mode near term. Let us be clear, though. There's not exactly blood on the streets. In fact, broader valuations in many growth stocks remain closer to the highs than lows, even with some significant pullbacks. We remain relatively cautious, broadly speaking. Given our cautious stance, 2018 has seen KeyStone recommend only 5 new buys to our clients in our Canadian growth stock research, where we typically find 10 or more. This has left many of our clients with significant cash positions. positions that we are very comfortable with. If the markets continue to be volatile, as Warren Buffett would say, we will be greedy when others are fearful. So without further ado, let's get to the interview.
What do you think about the XBEC adsorption? This is an XBC on the venture. You say you know it, but maybe you don't know.
Yeah, well, I have trouble saying their name. I do know that. And we actually met with management in Toronto. We came in the spring. I think that the company's a good business. I think that they had a landfall contract that they signed, a windfall contract that they signed recently of $55 million. So that added to their backlog significantly going forward. The issue, profitability, the last quarter was actually decent. So we saw an uptick in profitability. That checks one of our boxes. They're guiding next year towards good. I think it's in the range of 5 cents. There's a wide range that they have in terms of their guidance, but it's in that range. If they hit that, in the current price that they're trading at right now, it offers decent value. We have to see management hit their targets. We like to actually monitor them and see if they put out a guidance and hit that. That'll confirm that we can trust the guidance going forward. So I think that there's a lot of potential there. There's certainly a lot worse companies out there. This is one we're monitoring, and we have it will be included in one of our special reports coming up, but it's not a recommendation right now.
All right, fair enough. Let's get to some recommendations. Another topic here from Ryan Irvine is Sylogist, and this stock has done exceedingly well. You're looking at the ticker SYZ. Yes. And this one's on the venture.
Yeah, we've owned it since around the $7 range. It's done tremendously well for us. It's really just a good, solid business. And the balance sheet, like we keep talking about balance sheets today, $30 million in cash in the bank. It's like $1.50 per share of the company. There's no debt here. So this is a company, if there is a downturn, they will go out and make acquisitions in their market. What do? They provide software, so back-end accounting type software, enterprise planning software for nonprofit organizations, government organizations, and K-12 schools. So good, solid business. It's a SaaS model. About 70% of their business is software as a service, so recurring type business, which we like. It gives us predictability going forward. It's upped its dividends, I think, each year for the past 5 or 6 years now. We love that it pays a dividend. It's yielding about 3%. They just this month upped it another 18%. So, it's upping its dividend every year. Some years we've got a special dividend in it. We think next year they may take a little bit of pause in terms of growth, but that can change in a second with a good, solid acquisition. They made a good, solid acquisition of a K-12 software company just this time last year, and that added to growth over the course of this past year. We saw really strong growth in the business. I think that it'll earn 85 cents adjusted earnings or adjusted EBITDA this year. Right now it trades at a discount to what we think is fair value, around $16. So we think there's still a lift in the shares. You're getting paid that dividend. The company at any time could make an acquisition that would be accretive. So that's what we like. We like a business that has that can profit in a downturn, profit right now. And management has done a good job with this business. They own a significant amount of shares too. So we love to see them pulling on the same rope as us.
My one follow-up would be that it looks like it's not that liquid with average volume of 33,000. Is that a very good potential problem for a retail investor?
It can be, but we're looking 2 to 3 years out most often. So if you put a limit order in, if we put a buyout on this company, we always say here's a limit. Say you're buying between 13 and 13.25. Stick that limit order in, have it in for a week even, and get filled over that time. Often you'll get filled within a day, right? But if you're trying to buy a huge position, you need to have that limit order in there, and it can be difficult. So it's not for every investor because of the lack of liquidity. But we believe, and we've seen this happen with these type of companies over time, the more as more people start to see the great cash flow, the earnings coming out, the more liquid it can become. The other thing is, companies like this with cash-rich balance sheets, cash and cash flowing positive, and trade at reasonable valuations, they can get bought out. Now, we don't buy companies just because we think they're going to get bought out, but it can be a nice way to cash out on a company, if you've built a position over time, and we've had that happen a number of times.
Another stock you're recommending today is of the larger variety, nearly a $5 billion market cap, and this is more so from your colleague Aaron Dunn, but you know of the company as well, Parkland Fuel.
Yeah, no, it's a good solid business. I asked Aaron, I said, let's have one income related stock that also has growth that we can talk about today. And they're a refined fuel distributor for commercial, for retail, and for wholesale supply. So they also are the second largest convenience store operator in Canada. So at the pump, essentially, right? It's a good solid business. They just made what would be another transformational type acquisition for them. They bought the largest refined fuel marketer in the Caribbean. So an interesting area to buy it in, but we think it'll be about 17% accretive on the positive side to distributed cash flow over the next year. We think it trades at reasonable valuations. We think it'll do a distributed cash flow around $3.60 this year. At just 14.5 times that gives you our fair value. Aaron's fair value right now is around $52. So that's a significant lift from where you are right now, and you're getting paid about a 3% dividend. So it's a good dividend, and it's a good, solid business.
What do you make of the rollover here? Is that just sort of standard consolidation and getting caught up in the downturn?
Yeah, I think it's an opportunity. There's part of that, but they had their last quarter. There's several analysts that follow this that had what we would say overly optimistic expectations, and the company had tremendous growth in their last quarter, but there was expectations out there that they grow beyond that. I think it's an opportunity to see this business grow long term. You buying it, at a discount. Like we said, these are the times when you want to buy, when you've had a correction, not when it's trading at 52-week highs. So we'd rather buy when there's been a correction, and we're holding this 2 to 4 years going out, and I think it offers good value here.
Ryan has given you 4 of his top picks so far. 1 more to come. He's got a bonus pick as well. We'll also continue to take those questions of yours. So. Let's do full disclosure here. Let's make a very important correction. You referred to Tinder earlier, and we have gentleman writing in here, Pratsy, I think. He says, I think he means swiping left. Swiping left is bad. You're rejecting them.
Yes,
swiping right is good.
I'm actually happy that I don't know that, because I think my significant other, she'd be very pissed off if I knew actually what swiping right and swiping left. So I should have known that swiping left we are discarding. Swipe right would be those very select few,
exactly.
Like my significant other that I would actually select. Right?
Yeah, and your significant other, and the swiping right, you're swiping right on your top picks today.
Yes.
So let's swipe right on Sangoma Technologies. This is your bonus pick today. The last year it's up 56%. Over 5 years, nearly 500%. So here's another beautiful chart and a nice looking company.
Yeah, it's been a great holding for us. Flies under the radar, but I mean it's a good solid unified communication business, providing VoIP-based phone systems for business environment, all the type of voice data and communications that you need on open source software systems. They just made a transformational type acquisition for the business of a company called Digium, which owned the Asterisk platform. So a very under the radar story. This company a year ago this year just did about $57 million in revenues. It's going to do $100 million this year going forward. So tremendous growth in terms of revenues. Earnings or adjusted EBITDA, the company is forecasting about $9 to $10 million this year. So that's a 50% rise from what we saw last year. When you have growth at that, trading at relatively reasonable valuations, we believe based on their guidance going forward, their adjusted EBITDA guidance going forward, it's probably worth $1.60 to $1.70 right now, and that's not with any further acquisitions. They've been it is difficult to be a growth by acquisition story because your return on capital has to be great with those businesses you buy to make sure that the dilution from share issues, to make sure you'll be able to grow earnings on a per share or grow cash flow on a per share basis. They've done that really well, walked that tightrope and done it well. We think with this acquisition, which is transformational to them, they will continue to do that going forward. There's the recurring revenue base has moved up to about 35% over the course of this year now. So again, we love those companies with those recurring revenues, and I think it just trades at reasonable valuations and trades under the radar. There's basically no coverage on the company right now, so it's one of those that we'll hold for 2 to 4 years, let management do their thing, grow earnings over time, and I think it will continue to perform well over time.
I said the chart was beautiful. The 1 year isn't exactly beautiful. It's okay, but the 5 year is really quite something. Now, you mentioned growth by acquisition. That makes me think of, say, a Constellation Software, for example.
Yeah.
Which beyond this one, which are the companies on the TSX that impress you in terms of being able to maintain that growth by acquisition?
Yeah, I mean, Boyd is a company that's been able to do that. Like, I mean, I referenced them a couple times, just tremendously well and walk that tightrope. And they've issued debt to do it as well, and convertible debentures, done it really smartly, and just been an absolute powerhouse in terms of acquisition, growth by acquisition. Enghouse is a company that we admire as well, run by Steven Sadler, software company. They employ that capital, and they're not issuing shares at all. This is the model we completely love, because they make acquisitions out of internally generated cash flow. Right now, they have a record cash balance in the business. I think that they're smart allocators of capital. I think they'll continue to grow and outperform long term. We've owned that company for about 8 years. The dividend increases every year. The dividend's not huge, but it's nice to have that dividend increase every year. Share price over 8 years has done tremendously well. It's had a pullback of late. I think it offers value going forward, and it's just one of those stories that has been able to grow via acquisition. But there's no dilution there. And Steven Sadler, the CEO, owns a good chunk of the business. He's pulling on the same rope as us. Cash-rich company, relatively reasonable valuations. It's not cheap, but you're paying for a quality name.
Ryan, just back to Boyd, and you talked about real-world examples. I was with my wife last night. She had a minor fender bender a few days ago. We had to go to this collision center in Toronto at about 9:45 at night. I would have rather have been on the couch watching Netflix or something, but I accompanied her, and there were tons of cars in the parking lot, all these bashed up cars, and it just shows you, maybe not as much as death and taxes, but it's just one of those things. People get in car accidents, and hence Boyd has this very steady business.
It's true, and I used Boyd to replace my windshield. I had a cracking thing. So it's great to actually use them, and it was a good experience. So that's good. So anecdotal right there is good, but. People have concerns too, like you wait, the autonomous driving cars, right? Like, okay, will we have less accidents? Probably, but their primary business is just glass repair, right? So you're still going to get those dings in your windshield, and even if there's an autonomous car, they're not going to avoid a rock chip coming up onto your windshield. So we're looking forward on that, and you're still looking quite a ways forward till we have a substantial amount of autonomous driving cars, but. We still think that business can thrive there, and you need those businesses that will thrive in a downturn or do well in a downturn, and we see it as recession resistant. So I think Boyd is still, it's not cheap right now, but it offers value right now, and it's actually come down from its highs of about $125. So we originally bought it at $2.30.
Nice.
People say we're crazy to get recommended at $100, but you look at the business unto itself. And if we think it has 20% growth over the next year, and you can get 20 to 25%, you still buy that business.
Okay, so now on to your last top pick among the five. The bonus pick was Sangoma Technologies. Viemed Healthcare. Now, this is one that is being asked about by Jay Lee. And I believe he was the only one asking about that one. We had this as a cover story a while ago. Stock's done really well. Even with the recent pullback, it's still pretty well doubled in the last year or so, and this specializes in the obstructive pulmonary
chronic
disease.
COPD.
Right.
They provide vents into the home, ventilation systems, and the actual nurses essentially that help the patients with those system on a 24-hour basis. So it's a great model. They essentially, like, COPD is a terrible disease. These are end-of-life patients, and you're helping their quality of life at that end of life. But what the cost of them going and getting readmitted back in a hospital is great. So the model seems to work quite well because you're saving the system money. Now, what has hit the stock recently? I mean, over the course of this year, tremendous growth in Q1, tremendous growth organically, all organic. That's the type of growth we like. And by organic, I mean they're not needing to make an acquisition to grow. But Q1, Q2, and Q3, tremendous growth in terms of underlying EBITDA and revenue on the top line, or organic growth. But there is the CMS, which is a Center for Medicaid and Medicaid and
Medicare.
I can't speak.
That's right.
That's right.
Yeah.
And they have come out and stated that this may go into a different payer category. Like it may. Sorry, I'm getting that wrong. The company may go to a bid process that is called a competitive bid process. They're not in a competitive bid process right now. It's kind of complicated, the process that leads to them getting a payer right now. But that could be a potential negative for the business. Now, that would not come into the fold for another 2 years. So they've had cuts from CMS in the past. Like in 2017 or 2016, they had a 35% cut. And the company, that's a negative to the business. It's a cut in the amount that they're reimbursed by Medicare. Now, that is a negative, but the company went out and just grew its business, grew and outgrew that cut, and produced the quality numbers and growth that we saw over the first 3 quarters of this year. We think they can adjust to that it's well-run business. We think they can adjust in this environment, but the markets hate uncertainty. And when you have this type of uncertainty out there, that's why you see the very volatile trading in the company going forward. On an earnings basis right now, it offers good value. There's that, there's the uncertainty around the company. We think the management can navigate through this environment, and we would hold it as a spec buy in a portfolio right now. Maybe a half to a full position in the portfolio and looking out 2 to 5 years and letting management, again, doing what they do and grow that business organically. If you did not have that CMS uncertainty over this stock, it'd be a great buy right now. But that is there. This can happen. That is the risk with any company that's receiving payments from Medicare or Medicaid.
So Ryan, in our remaining minutes, what have we not talked about that you'd like to touch on in terms of investing advice or lessons learned or certain companies?
Yeah, I think that one of the things we always say is if you want to beat the market, that's what we're all really here to do. You can't just be the market. I think you need to have great stocks in your portfolio, but you want to craft that portfolio. You don't want to own 50 or 100 stocks because we always teach this in our seminars that we do as well. Past 20 stocks in your portfolio, a reasonable diversification within those 20 stocks, you're not getting any benefit of diversification anymore. So that's why we like to structure and buy with conviction good solid companies between 10 and 20 stocks in the growth-oriented area of your portfolio. And then if you do have an Expel or a Boyd in your portfolio, the returns that you get from that company actually make a difference. If you have 50 or 100 companies in your portfolio, first of all, it's very hard to manage. But also on top of that, a company has a 200% gain in a year. It's not a big percentage of your overall portfolio. So we would say that buy with conviction and concentrate. We say focused diversification. 10 to 20 stocks built, not bought all at once. If somebody comes to me today and says, give me your 10 buys, give me your 10 buys, I think that's the last thing you want to do because, our system is we're buying over 6 months to an 18-month period, and that helps you avoid buying at a market top. So, if there is a correction of 20% in the next 3 days, if there's a correction, and you started 3 months ago with our research service, well, you may have bought 3 companies, but you're going to, you're going to now be able to, and they may be down because there was a market correction, but you're going to be able to then add after the correction. So that's why we think it's the best methodology to buy over a period of time, not buy all at once because you have too much market-specific risk then.
Ryan,
hopefully that helps.
Yeah, absolutely that helps. And everything you have said through this entire show, I'm sure has helped investors. Let's do this again. That was great.
I'd love to be back. Have me back anytime.
You could talk all day.
I probably could. Yeah. I get the sense, and I could. We could go on and on. This could be a 2-hour, 3-hour show.
Well, see, the beauty of the internet, we could go 5 hours if we want. We won't do that.
I got to catch a flight, so I don't know if I'm going to do that. But yeah, for sure.
Okay, thanks again, Ryan.
Have me back.
I would like to thank everybody for listening to this special edition. Keep your questions coming for our Your Stock, Our Take segment, and we just might answer one of your questions in an upcoming episode. As always, I wish you profitable investing.